Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alekh Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alekh, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news,
Yeah.
and you don't know, tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well. They're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So
That's
it's like, twin fears working together.
Exactly.
But in generally, I mean, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed? Gold has done so well. So I think people are just asking themselves these questions: that where should I be?Here should my money be?
So we have been overweight gold for a while, for actually the last 2 years. Actually went overweight when Ukraine and Russia crisis broke out in 2022, and we've been overweight in gold since then. Now I think we're starting to book a little bit of profit because it's been a stellar rally for gold. So we're booking a little bit of profit. We're adding a little bit to equities. If you look at Indian markets, things have only improved. The macro environment has become better. The government is starting to spend. RBI has cut rates by more than 1%, and is also supporting liquidity by doing open market operations. So the overall macroeconomic environment in India is improving. On the other hand, the earnings sort of bottomed out in the last quarter. I think the expectation is that they will keep improving quarter on quarter, and the second half of this financial year should be a better year. And that's why we're saying that slowly, gradually add to equities and don't miss out on the rally. If there is correction for whatever reason, it is likely to emanate from global market risk. Use that opportunity to add to equities.
So equity would be the one big asset class that you're advising that investors should they should be putting in their money. What else, just in terms of asset classes?
So that's one. Gold, we still have some allocation. We're not fully taking out.
How much?
Generally, our model portfolio allocation is about 10%. We were right now at closer to 12%, slightly overweight on gold. And on the debt side, we are saying that maybe it's time to book out money from duration and add to conservative debt like corporate bond funds, and using income plus arbitrage as tax efficient vehicles to take allocation to debt.
Okay, so that's the overall thought process with respect to where the money should be parked. That's the Sanctum view. But now I want to get to the exciting part. Because the way Alekh has done this is that he's going to encapsulate all the mistakes we end up making in a panch ka punch. So the 5 to avoid. Take it away, Alekh.
Yeah, so I think the first one, that we typically see in client portfolios is over concentration or over diversification. So generally investors who have been investing for a long period of time, HNI investors who have a larger portfolio, they tend to end up accumulating too many mutual funds. We've seen in client portfolios with 40, 50 mutual funds as well. And as we know, each of these mutual funds have about 50, 60 stocks. So you overall end up owning like 1,000 odd stocks, almost the entire market. That's too much of diversification. On the other hand, newer investors who started new, they end up doing 2, 3 mutual funds, maybe 4, 5 mutual funds, and have a concentrated portfolio. There again, what happens is that if there is a good experience with one fund, you got it at the right time, you end up owning 20-30% in that one mutual fund. So that's too much concentration. Our ideal, this thing is anywhere between 5 to 15% allocation to one single mutual fund, which means around 8 to 12 mutual funds on the equity side is more than enough, and that should cover for you.
8 to 12 funds. Because this is something that people always grapple with, and sometimes people have multiple advisors. So you have one portfolio with one and another with the other.
Exactly.
So you're saying no more than 8 to 15 funds.
Yes, that's right.
Okay, so that takes care of the over-diversification part of it.
Yes.
If someone does have a big portfolio right now with like 20-25 funds, and they need to basically clean it up and come down to what you're saying.
Sure.
How do you start? How do you prune it and get it all together?
Sure. So the second point comes in, which is the diversification across market cap as well as style. We'll talk about both of them. But here, what we should look at is that you should have funds in each category. Some flexi cap, some mid cap, some small cap. Some large cap mutual funds, and then diversification across style is also what you need, and we'll talk about that.
All right, so mistake number one to avoid, do not be over diversified in too many funds. That's number one. So what's the second mistake to avoid?
So second one is market cap, and that is very pertinent right now because we've seen a stellar run for mid and small caps. They've outperformed large caps almost, like small cap index has done double of large cap in the last 5 years. So and investors look at past returns while taking decisions. So one may be a little more skewed towards mid and small cap at this point of time. And we know mid and small caps also have their cycle. So that periods where they do extremely well and periods where they underperform as well. As a thumb rule, what you could look at is the overall market cap for India. If we were to break it in large cap, mid cap, small cap, about 70-75% would be large cap. 20-25% would be mid cap, and the balance 5-10% would be small cap. So that could be your guiding tool. And depending on if you're aggressive, then you could have, say, maybe 40% in mid and small cap, and if you're balanced in less.
But that's the thing, because the last couple of years, large caps have not been delivering great returns. Therefore, people have wanted to go to mid and small caps in search of better returns. So what do you say to that? Because it's a valid argument, right? Because foreign investors are not coming in, so you're not seeing big moves in big large cap stocks. So if you're stuck there, you're forever going to be underperforming.
Yes. So I think the right way to take that large cap allocation is through Flexi Cap Funds. And Flexi Cap Funds will have about 50-60%, 70% large cap exposure. They'll do their picking up of the right stock, which will add a little bit of alpha. And then they'll use the mid and small caps to also deliver good returns. And if you look at Flexi Cap Funds, they've done really well. Some of them have done really well in the last 5 years. So that is, I think, the way to go ahead rather than just doing pure large cap mutual funds.
Okay, so maybe Flexi Cap Funds could, give you that edge, because ultimately it's the portfolio manager, the fund manager, who's going to decide whether it's time to load up on some additional well-performing mid caps or not. So second mistake to avoid, don't get carried away by the market cap classification and design your portfolio only as per the particular class of stocks that's doing well at that point in time. So that's two. Mistake number three.
So the third one is style diversification. We just talked about that. And this is a little tricky because, it's not very intuitive. So I'll just briefly maybe take 1 minute to explain what these styles are. One is growth investing, which is basically investing in companies where earnings growth is very strong. Valuation is not as relevant because the earnings will make up for it. Other is the exact opposite, which is value-oriented investment, which means you invest in companies which are cheap in terms of valuation. Earnings growth may not be as important, so that's growth value. Then you have something in between, which is called growth at right price. That means you still buy growth, but at a reasonable valuation. And then you can have either a quality bias or a momentum bias as well. And there again, these styles also see cycles. So, there could be time periods where, like for example, last 3 years, quality has underperformed significantly, and investors may completely be away from quality. They may not pick any of these funds, but quality could come back. So having a little bit of allocation everywhere makes sense, but you can have a bias towards what is working right now at that point.
So, I mean, in the practical sense, how do you apply that? Because Indian mutual funds don't necessarily advertise themselves as, okay, I'm a growth fund or I'm a value fund. And that portfolio could have a mix. It could have certain high growth stocks. It could have certain underperformers, which the fund manager feels could turn around. So how do you practically implement this?
So the way to do that is having diversification across AMCs. AMCs generally have a style. For example, Access as an AMC was doing really well up to one period of time because quality bias was helping them, and now they've underperformed because quality has underperformed. So having not being concentrated in one AMC can actually help you. And AMCs tend to have their own style. So if you our thumb rule is that in any AMC, nothing more than 30% of the portfolio.
Okay.
And if you do that, then you will have.
Okay, give us, since you mentioned that some AMCs tend to have a certain style characteristics.
Yeah.
So the ones where the style is pretty clear or evident, give us some examples.
Yeah, so for example, HDFC, in their Flexi Cap and focused this thing, they are a little more value-oriented fund house.
They're like value stocks.
They're value stocks. When Prashant Jan was managing it, it was completely value.
Completely
and
value,
with Roshi, it's a little more GAR, but still value-oriented. So they're on that side.
Okay.
Motilal, as a fund house, is a little more momentum, a little more earnings growth-oriented. And then you have Invesco, which is a little more balanced. It does a little bit of growth, a little bit of value in their funds. As we said, Axis, has a little quality biased. They've had quality bias historically. In UTI, while the fund house doesn't have a style, but something like a UTI Flexi Cap has been a quality biased mutual fund throughout.
Okay, that helps. So we can keep that in mind. That's the inherent nature of some of these funds of the fund houses. And then you can do a mix and match when it comes to your portfolio. So that covers the third point, 3 mistakes to avoid. What's the fourth mistake to avoid?
So the other thing is NFOs, new fund offers. So new fund offers, at new fund offers, you don't have a past track record. You don't have past portfolios that you can look at or the current portfolios that you can look at to take decisions. So the decision is based on themes or narratives that the AMC is talking about. And there you could, and so there one should be a little more selective. If it's a theme which is not there is no other investment option available in that theme, then you can go ahead and do the NFO still. But if it's a theme which is well played out, like a mid cap, small cap, there are multiple other options, then maybe it's best avoided, wait for some time, look at how the fund does, and then participate in that NFO.
Okay, so don't get carried away with NFOs. That could be mistake number 4. But let me ask you about this, because in the last year or 2 years, every time a sector has done really well, you'll definitely see AMCs coming out with funds. So defense, we saw that. Manufacturing, we saw that. Now, maybe the long-term narrative cannot be denied. Maybe there is a long-term opportunity there. So for instance, on defense, what is your house call right now? To be in these defense funds or to completely steer clear?
So I think right now, defense stocks have rallied a lot. The whole India-Pakistan issue also, sort of helped these stocks do well. Some of them have run ahead of their fundamentals. So our view right now is to sort of book profits from defense. Back when HDFC had launched the fund, I think it was a very good time. It's done well, since they launched.
Is there any thematic or sector fund that you like?
So right now we are a little more biased towards financials. I think banks right now are trading at valuations which are lower than historical averages. So any fund, funds which are biased towards banking and financial services, BFSI funds are funds that we are positive on right now.
All right. Otherwise, not getting too carried away with the hot sectors that are, the top trending, so to speak. Okay, so that's 4 mistakes to avoid. Which is the 5th one?
So 5th one is similar. This is sector and thematic funds. Even if they're not NFOs, they are funds which are ongoing. Investors may be overexposed to thematic funds. Generally, by the time it becomes popular, by the time it's there in the narrative, it's already run up, and that's probably not the best time to enter. So limiting your thematic exposure to maybe say 10 to 15% of the portfolio and keep the balanced in Flexi Cap, whatever categories you want to invest in, is probably more prudent, and just have like 10-15% in sector thematic funds.
Okay, all right. So 5 rules to keep in mind when you're looking at your portfolio, evaluating your portfolio, either yourself or with your advisor. Let's quickly do a recap. 5 mistakes to avoid in your portfolio plan.
So the first one is too much concentration or diversification. As we said, the right balance is between say 8 to 15 mutual funds. The second is market cap allocation, not being biased towards one market cap, having a balance between large, mid, small cap is the second point. The third point is style diversification across growth, value, and quality. The fourth point is NFOs and being selective about NFOs. And the final point is thematic and sectoral funds, being selective about thematic sector funds and limiting exposure there.
Okay, all right. So remember these 5 pointers when you're looking at your portfolio plan. We do have to take a very quick break on that note. On the other side, as promised, we're going to do a quick dipstick on hybrid funds. Why perhaps you may want to use these funds to diversify beyond equity as well. Are there some good funds out there that you should consider? We'll discuss this after the break.
Let's talk money